Hi, I'm Michael Landsberg, Chief Investment Officer of Landsberg Bennett, Private Wealth Management. Welcome to our third quarter market update for 2024. I'm going to cover three major areas: interest rates, inflation, and also the sector setup, and kind of going forward into the fall as we see elections. Interest rates, we're in the belief here that you're going to see the Federal Reserve cut interest rates, not at this upcoming meeting, but in the fall meeting. And there's a good chance they even cut it 50 basis points or 0.5%. The reason we say that is we think really inflation is kind of at an inflection point now. It's slowed, and we think it's about as low as it's going to go. And in fact, a lot of the comps, and the way inflation is calculated is it's done on a year-over-year basis. So the easier comps were from a year ago. And so as the comps get a little harder and harder, we think it's going to be a scenario where inflation actually does re-accelerate in the back half of the year. And I think the Fed knows this. If they can get a 0.5% cut in before they see inflation re-accelerating, I think it actually gives them the ability to do that. Why we say that is there's parts of the economy that inflation hasn't waned. Housing costs, for example, shelter, hasn't gone down. It's still, in that 5% area. And what's interesting, and something that we said earlier, we thought the Fed was going to actually play a little game of chicken with this 2%. We thought that they wouldn't get to 2%. And everyone said, oh, they're going to stick with their policy. And my belief was, in order to cut interest rates, they're going to have to deviate from that. And actually, the last statement Powell made, he said, well, we don't have to have it get to exactly 2% to cut, which basically is him admitting it's not going to get to 2%. They'll get their cut in, but in reality, we think inflation is going to pick up a bit. Again, the shelters being one of the areas. And also in the offing, we're seeing the price of shipping in the world, and a lot of the shipping comes from China. Shocking that we don't make anything in the United States anymore, and China makes a lot of stuff, and it gets shipped all over the world. The cost of shipping has gone up between 100 and 150% in the last 6 to 8 months. And that generally takes a year to year and a half to kind of show up in some of the inflation data. That's probably going to hit like that fourth quarter, first quarter of 2025. So although we've seen inflation kind of come down from these crazy levels, it's kind of been stuck here for about a year, enough to give them some pause and be able to get them a cut. In reality, we're going to start to think it's going to start to go higher. Do I think it's going to go back to the 9% headline that we saw? Absolutely not. But do I think it's going to head towards 4? Yeah, and I think that's a scenario that we have to look at. Is that a bad thing? Not necessarily, if you're prepared for it. If you remember when inflation went to 9%, we were long commodities, and commodities did very well. So if you're long or own things that will do well in inflationary environments, inflation's not a bad thing. You just have to kind of be prepared for it. So that's our scenario there with interest rates. We think that's going to be a scenario where it dovetails into inflation, which inflation will kind of go a little higher and will keep the Fed kind of in this higher for longer environment. We think inflation is going to remain higher for longer than people want. We think interest rates are going to remain higher than people want. So I think what you're going to see is a cut in this next meeting, that September meeting. But I think then we're going to see an environment where we're going to kind of stay put for maybe 6 months, maybe 9 months until some of this data kind of goes through. Looking at the data is not bad. Unemployment's very, very low. Albeit a lot of those jobs are created by the federal government. But with that being said, unemployment's quite low, which again is a reason really not to cut rates aggressively. Historically, for those of you that have been watching the market for a long time, I've been in this business 30 years, when stocks are near all-time highs and risk assets, such as Bitcoin, are near all-time highs, you generally don't see the Federal Reserve cut rates to get things moving, because things are moving quite well. So really this cut is more of a matter of Powell going to some of the people that are clamoring on Wall Street that are highly levered. Hey, I'm paying a boatload of interest on the margin accounts, in essence, my leverage, lower some rates to give us a break. So that's really what it is. It's not to get the economy moving. The economy is moving quite well. With the exception probably of India, the GDP in the United States is as strong as any place. Now, again, I mentioned India. We've owned India. We like India. We continue to like India. It's probably the best country on the planet to own because they're in that growth mode. But with that being said, the United States is still not a bad place to be. But the scenario is it's not typically an environment you see an interest rate cut or a series of cuts because things are going too well. Generally, you cut rates when things stink. Hey, we're not making any money. The stock market's in the doldrums. We got to get this thing moving. That's not been the case. In fact, actually, the argument's been, the market's been a little bit more concentrated and more heightened. It's certainly not been in the doldrums. You've seen stocks up 100% in 6 months or a year, typically not a time when you get interest rate cuts. But again, we think we're going to see one. We think it's going to be one and done, at least for the foreseeable future. And I will be surprised if they try to get another one in before the election other than the one, simply because I think there'll be a lot of political pressure not to cut rates because one candidate thinks it's going to help the other one. So I think that's kind of where we are in the interest rate and inflation setup. And globally, I mentioned India. We like some other countries outside the United States, particularly, like I said, India is one, Japan is another. And there's small parts of Europe that we like. The most of Europe is okay. But places like China, we don't like. Places that are commodity oriented right now. We think the Chinese market's an area that we'll avoid. And in essence, sometimes you may even see positions that bet against China, simply because we think that market, as much as they control it, demand is not there, and they've got some real problems with banking, among other things. So you're going to see us avoid those areas, in fact. But again, India is an area that we like, we continue to like it, Japan. In the US, again, we've had a rotation, and that's common. Tech has basically been a great place to be for the last couple of years, and we've seen a rotation. Does that mean that we don't like AI longer term? No, that's not what that means. It means over a period of time, you'll have some times when things are more in favor than out of favor. That's one of the reasons that we rebalance portfolios a couple times a year. And a rebalance basically means we take some money from the winners and move it to some other places that haven't won as much. So for example, if you look back and we did the rebalancing earlier this summer, tech in some of the positions that were 4 and 5% of the portfolio in January were 7 and 8% of the portfolio. Now, we didn't eliminate them, we just took them back to that level, that 4 or 5% that they should have been, and spread that money out. Typically what you get, and it's a rebalance, is some sectors will do well, then they'll have a period where they pause. And what you don't want to do is have an environment where you hold them too long, and then they become a larger part of the portfolio, and then if they don't work. So one of the issues you've got with stock indices, like the NASDAQ or the S&P 500, is they're cap weighted, which means the bigger companies get bigger, the better they do. So it could be 4%, 5%, 8%, 10%, which is great on the way up. But the problem is when it goes down, now that stock is 10% of the portfolio. So when it goes down 10, 20, 30%, it eats up a lot more of your value on the downside. One of the reasons we rebalance is if it's a 5% position, it goes to 8, we want to trim it back to 5. If it goes back to 7, at some point, we'll trim it back to 5. Think of it kind of like a rose bush. You're pruning that constantly to get more roses. Sometimes if you let things kind of grow wild, they get wild and get some roses, but ultimately it's not as good and effective as kind of trimming it and keeping it, kind of tight. And that's really what we do from a portfolio standpoint. One of the things that we can control as portfolio managers is risk. And so if we weren't called private wealth management, we'd be private risk management. Because in essence, what we do is we manage risk in portfolios for clients. And what the indices don't do is they don't manage risk. They get more aggressive as things go up, and then they become more aggressive when things go down. So we want to keep that static. We want to say, okay, if my client is willing to take X amount of risk, if things go well, we want to trim it back to X amount of risk. Conversely, in an environment where stocks do poorly, we want to up the level of risk. So we want to say, okay, we had a bad environment, we'll kind of gross up our level of risk to make sure that our client is consistent with the level of risk they want to take to meet their goals and objectives. So that's also important. In the United States, there's some sectors that we like. We're entering into an economy right now. We see growth slowing, and we see inflation, or interest rates rather, going down. So that's an environment where that may be well for utilities. It's an area that we have. We'll probably continue to add to that. We also like healthcare in this environment. And there's selected parts of the financials that will do well when we see these kind of rates go where they are. So that's kind of the idea broadly. Again, rebalancing is important to lower risk in the portfolio. We see good opportunities. We think the fall is going to be choppy. No question. We've had a crazy few weeks with an election, with some variabilities that we've never seen before. Basically in the last month, we've had basically a debate that was a train wreck. Then we've had an assassination attempt. We've had a party replace somebody after there's been a nominee. It's a very new world that we're in. Presumably Kamala Harris will be the nominee for the Democrats. Obviously, Donald Trump will be the nominee on the Republican side. But we're entering into an environment where we've never had before. Assassination attempts. We haven't had one of those in 40 plus years. And again, we've got a candidate that is now going to be running for one party that wasn't in the primaries. And so that's also, kind of a different scenario. So I don't know if we're going to see debates. I see that kind of back and forth. So I think you're going to see some interesting things. I think the market prior to Biden leaving was trading more on a Trump win, and you saw some of the asset classes that were indicative of, or at least the market thought were going to benefit if a Trump victory. Those have traded off a bit now that Harris is in the race, and it looks to be a dead even race in a lot of states, at least a lot of key battleground states. And so that's important to watch. We'll kind of see where we are. We don't like to make predictions too much on who wins, for the simple reason that if you look historically, when there's been basically a Republican in office, a 60-40 portfolio, and I say office, the presidency, has returned 8.1% historically. If there's a Democrat in office, it's been 7.7. So in reality, we're talking 0.4% difference for all the back and forth. So as portfolio managers, we don't really get involved too much with if this is going to change. It's not going to change the dramatic returns too much. What changes returns are the companies making money. Are the companies doing the right things with their cash? Are they spending the right money in R&D? Are they watching expenses? Are they growing earnings, growing sales? That's what's important to stocks ultimately. So a lot of this nonsense in terms of back and forth is who's going to win, who's going to be better for stocks. At the end of the day, it's not a significant difference in who's better. Now that's overall with the market. That's not to say that if a Republican wins, there aren't sectors that Republicans typically favor that will invest in those. And conversely, if the Democrats hold on to the presidency, we may alter some of that and go to some of the things that continually do well if Democrats are leading the country. So the primary difference is if you have a blue wave or a red wave, that's actually where those returns are even better. So that's a scenario where they're another 1.5% higher if one party sweeps both. They have the presidency and the Congress. So we'll keep an eye on that. I just don't see that, but we're going to kind of look at that. And that would be an indicative of maybe a portfolio shift after the election to say, okay, one party is kind of either gotten 100% control or there's a split leadership. What does that look like from a stock standpoint? At the end of the day, stocks go up because of earnings. Make no mistake about it. A lot of short-term noise about this and that. At the end of the day, if a company makes money, they're growing their earnings, stocks will go up over time. And we look at that, we look at the dividends. If you're growing your business over time, stocks go higher. And we're still seeing that. You're still seeing S&P 500 earnings growth, at least this quarter, up single digits. NASDAQ is up double digits. Even the poor small cap, which we've hated small cap for a long time. And again, I say hated, as an asset class. We really like our small mid cap portfolio. It's done exceptionally well. But if I look at the small cap index, which is the Russell 2000, it basically hasn't made any money for almost 3 years. And a couple quarters ago, earnings growth was negative 34%. Last quarter, it was negative 25%. And this quarter so far, it's negative 17%. So this analogy is it was an F student. Now it's a D student. Now it's maybe a C- student. You're starting to see the small cap market pick up a bit. And again, we've always liked what we've been able to put together because we think a lot of what we own in our small mid cap portfolio are companies that earn money. About 40% of the stocks that are in the small cap index don't make any money. They have no profits. So we don't want to own that asset class broadly, but we still think there's opportunities in owning some of those names, 20 to 25 really good high quality companies. But we're seeing some rotation, again, out of those bigger tech names into some of the other ones. And again, that's what rebalancing does for us. We're not going to make a call, we're going to get rid of all of our AI, hop out, move into something else, and then try to get back in 6 months later. What the market dictates is what we do is we've had a good run, we trim, we lower our exposure, we put it in other places. If tech underperforms for the next 6 months, our January rebalance will add more money back to tech. And it did that. If you remember, in 2022 was an awful year for tech. So in January 2023, our tech exposure was boosted because of how poorly tech did in 2022. And that's really what we look at. We let the market dictate kind of where we go from a rebalancing. An analogy I heard long ago from a mentor when I worked on Wall Street in New York was invest for the market you got, not for the market you want. Too many people on TV are talking about what they want to have happen, and what we look at is what's happening, how do we react, how do we protect our clients' portfolios and their capital first, and then secondly, how do we make money? As Will Rogers said, obviously return of principal is first and foremost. We certainly want to protect principal, but we want to make sure that we're not going backwards. So with that being said, we appreciate the trust and confidence you show in our organization. We enjoy working with all of you. Please have an enjoyable rest of your summer into the early fall, and we'll touch base soon. Thanks again.